Imagine stepping into a maze where each turn either brings you closer to your goal or sends you down a dead-end path. For many, taxes can feel just like that, a labyrinth of rules, deductions, and obligations that can confuse even the most financially savvy. But here's the good news. With the right strategies, you can navigate this maze, take control of your tax liability, and maximize your savings. In today's video, we'll explore some powerful tax strategies for savers, including retirement accounts, health savings accounts, HSAs, and more. By the end of this video, you'll have the tools to keep more of your hard-earned money and secure your financial future. Ready to tackle the tax maze? Let's get started. When it comes to building wealth, tax-advantaged accounts are some of the most powerful tools at your disposal. These accounts function like hidden passageways in a maze, offering shortcuts to grow your money while minimizing your tax burden. Understanding how to leverage these accounts is crucial to maximizing your savings and accelerating your journey toward financial independence. Let's start by diving into the three most essential types of tax-advantaged accounts: individual retirement accounts, IRAs, 401ks, and health savings accounts, HSAs. Each of these accounts offers unique benefits, and when used correctly, they can significantly enhance your ability to save for the future. 1. Individual retirement accounts, IRAs. IRAs are one of the most well-known types of tax-advantaged accounts, and they come in two primary varieties: traditional IRAs and Roth IRAs. Both provide tax advantages, but they do so in different ways. A traditional IRA allows you to contribute pre-tax dollars, which lowers your taxable income in the year you contribute. Your investments then grow tax-deferred, meaning you won't pay taxes until you withdraw the money in retirement. At that point, withdrawals are taxed as ordinary income. This can be a powerful tool, especially if you expect to be in a lower tax bracket in retirement. A Roth IRA, on the other hand, works in reverse. You contribute after-tax dollars, meaning you don't get a tax break upfront, but the real magic happens in retirement. All withdrawals, including your investment gains, are tax-free. This can be especially beneficial if you expect your tax rate to be higher in the future. The decision between a traditional and Roth IRA boils down to a critical question: when do you want to pay taxes? If you think you'll be in a lower tax bracket in retirement, a traditional IRA may make more sense. If you believe your tax rate will be higher in the future, a Roth IRA is likely the better choice. In either case, contributing the maximum allowable amount each year is key to making the most of these tax-advantaged accounts. In 2024, the contribution limit for IRAs is $6,500, or $7,500 if you're over 50. The earlier you start, the more you'll benefit from the magic of compound interest, allowing your savings to grow exponentially over time. 401ks. While IRAs are fantastic savings tools, 401ks are often even more powerful, particularly for those with access to an employer-sponsored plan. A 401k allows you to contribute a portion of your paycheck before taxes, lowering your taxable income and allowing your investments to grow tax-deferred, just like a traditional IRA. One of the most significant advantages of a 401k is the potential for employer matching contributions. This is essentially free money. Your employer contributes to your retirement savings on your behalf, matching a certain percentage of what you contribute. Not taking full advantage of this match is like leaving money on the table. If your employer offers a match, make sure to contribute at least enough to get the full amount. It's one of the easiest and most effective ways to supercharge your retirement savings. Another critical decision when it comes to 401ks is whether to opt for a traditional 401k or a Roth 401k. The difference mirrors the distinction between traditional and Roth IRAs. With a traditional 401k, contributions are made pre-tax and withdrawals are taxed as income in retirement. With a Roth 401k, contributions are made with after-tax dollars, but withdrawals in retirement are tax-free. If your employer offers both options, deciding which is best depends on your current tax rate and your expectations for the future. 3. Health savings accounts, HSAs. While IRAs and 401ks are well known, health savings accounts, HSAs, are often overlooked as a powerful savings tool. HSAs offer a triple tax advantage that makes them unique among tax-advantaged accounts. Contributions are tax-deductible. This means the money you put into your HSA lowers your taxable income. Earnings grow tax-free. Like an IRA or 401k, the money in your HSA grows without being taxed on the interest or investment gains. Withdrawals for qualified medical expenses are tax-free. If you use the funds for healthcare costs, you'll never pay taxes on the money at all. HSAs are available to those with high-deductible health plans, HDHPs. In 2024, the contribution limits for HSAs are $4,150 for individuals and $8,300 for families, with an additional $1,000 catch-up contribution for those 55 or older. Here's where it gets even better. Once you reach age 65, you can withdraw money from your HSA for any reason without paying a penalty. If the funds are used for non-medical expenses, they are taxed as ordinary income, similar to a traditional IRA. This makes HSAs not only an excellent vehicle for covering healthcare costs, but also a versatile retirement savings tool. Maximizing tax efficiency. Now that we've covered the primary tax-advantaged accounts, let's talk about tax efficiency, the strategy of organizing your investments to minimize taxes. Think of this like choosing the most efficient path through the tax maze. You want to ensure that each investment is placed in the account where it will face the least tax friction. One key concept here is asset location. Different types of investments are taxed at different rates, so it's important to place them in the most appropriate accounts. Bonds and dividend-paying stocks. These are best kept in tax-advantaged accounts like an IRA or 401k. The reason is that interest from bonds and dividends are taxed as ordinary income, so placing them in a tax-deferred account shields you from paying taxes on them each year. Tax-efficient investments like index funds or ETFs. These generate fewer taxable events, so they can be held in a regular taxable brokerage account without incurring significant tax penalties. They produce lower capital gains, making them more suitable for taxable accounts. By strategically placing your investments in the right accounts, you can minimize the impact of taxes and maximize the growth of your savings. Tax loss harvesting. Another essential tax-saving strategy is tax loss harvesting. This strategy allows you to use losses in your investment portfolio to offset gains, effectively reducing your taxable income. Here's how it works. If one of your investments has lost value, you can sell it and realize a capital loss. You can then use that loss to offset any capital gains you've made from other investments. If your losses exceed your gains, you can even use up to $3,000 of those losses to offset your regular income each year, carrying forward any excess losses into future years. Tax loss harvesting is particularly useful in volatile markets. By turning a market downturn into a tax-saving opportunity, you can reduce your tax bill while keeping your long-term investment strategy intact. Timing your withdrawals and capital gains. Timing is everything when it comes to managing taxes. Knowing when to sell investments or take distributions from retirement accounts can have a big impact on your tax liability. For example, holding onto an asset for more than a year qualifies you for the long-term capital gains tax rate, which is lower than the short-term rate applied to assets held for less than a year. Similarly, once you retire, it's important to carefully plan your withdrawals from accounts like traditional IRAs or 401ks. If you can manage your withdrawals in a way that keeps you in a lower tax bracket, you'll save a significant amount of money in taxes over time. Required minimum distributions, RMDs. One thing retirees need to keep in mind is required minimum distributions, RMDs. Once you reach age 73 or 72 if you turn that age before 2024, the IRS requires you to start taking RMDs from traditional IRAs and 401ks. These withdrawals are taxed as ordinary income, and failing to take the required amount can result in hefty penalties. Planning for RMDs is critical to avoiding an unexpected tax hit in retirement. estate planning, and Roth conversions. Lastly, for those with substantial savings, estate planning becomes an important consideration. One strategy to minimize the tax burden on your heirs is through Roth conversions. This involves gradually converting your traditional IRA or 401k funds into a Roth IRA. While you'll pay taxes on the converted amount now, your heirs won't pay any taxes on withdrawals in the future. This can be an effective way to reduce estate taxes and ensure that more of your wealth is passed on to the next generation. Taxes are a part of life, but with the right strategies, you can navigate the maze, reduce your tax burden, and keep more of your hard-earned money. By maximizing contributions to tax-advantaged accounts like 401ks, IRAs, and HSAs, strategically locating your investments, timing withdrawals, and using tax loss harvesting, you can build a more tax-efficient and secure financial future. Remember, taxes are just one piece of the puzzle, but they're an important one. By understanding how to leverage tax strategies effectively, you'll be able to turn the tax maze into a clear, well-lit path to financial success. Take control of your tax strategy today and watch your savings grow for the future you've always dreamed of.